Hi, this is Brent, and welcome to the Trading Couch. We are talking about Uber. Uber was our clarity spotlight last week. Today is Monday, May 19th. About 1 o'clock, markets just closed. In our clarity article last week on Uber, we spent a lot of time talking about identifying and trading reaccumulation cycles, particularly because they're always masked with fear and really scary headlines. Accumulation structures and reaccumulation structures are always associated with very scary news. Wall Street is trying to either acquire or reacquire their positions after taking profits, which is why the news gets so scary. They want retail investors to get scared and sell out. So that's why it makes it so critical to be able to recognize structural lows. We talked about in our article how back in 2022, we identified the structural low in XLC, the communication sector ETF, which Uber is a large component of, and SPY. We identified the structural low there, not because the headlines told us that there was a low, but because we recognize institutional positioning. And no matter what the headlines say, don't ever forget Wall Street and the institutions are always in control, not the headlines. Let's jump into this chart. This chart was originally produced in March of 2024. At the time, we saw this impulsive wave structure coming out of the structural low in 2022. We can see that there's a significant amount of unrecognized gains on the table. We saw volume beginning to show signs of exhaustion. We saw price extending significantly above its longer term moving average right here. And those are our cues. That tells us to expect some sort of profit taking. It may come in the form of a sharp wave two. It may just be a reaccumulation sideways structure. Not sure, but we knew it was coming. We weren't calling a top. We just expected profit taking, not because of the headlines, but because of what the structure told us. This initial leg of the markup campaign was coming to an end. We expected to see institutions take profit to prepare for their next move. We saw the extension away from the demand zone. We saw declining momentum, volume contraction. And just like we teach in trade therapy content, after markup comes consolidation, typically in some sort of a very sharp pullback designed to shake out late buyers that are chasing at this point and reorient the tape. So let's fast forward to January. What we were expecting is exactly what unfolded. We got a textbook ABC structure. It came down sharply on the yen carry trade, a news cycle. It came down and found support right at this structural top right here, which is not surprising. We see volume spiking at the bottom here. It's in range of the 786 and the 200 weekly exponential moving average. This combined with the lack of selling pressure, meaning, look, as price began to fall, volume began to fall. Volume goes up at the bottoms, and that is classic reaccumulation. It surges on the low. That's the tell. This is not distribution, it's reaccumulation. Institutions never left. They just engineered a pullback so they could reload on scale and accumulate their position. And that's really the psychology behind these sharp pullbacks after a long period of price expansion. As profits are on the table, Wall Street wants to take those off of the table, and they want to push price as low as they possibly can. They want to punish buyers that have chased the euphoria, which is typically associated with breaking out to all-time highs right here. We can see the extension going almost vertical here. We can see volume beginning to surge here at the top. That is retail chasing Uber breaking out to all-time highs. And then we see the sharp pullback right here. That's by design. Composite operators need liquidity. They need to generate liquidity, and they do that by scaring weak hands. They do that with sharp pullbacks. Wave two can often come all the way back down in here, almost completely erasing wave one. We talk about in clarity content often how Wall Street creates the path of least resistance. This is how it's done. This is also why in trade therapy content, we're constantly telling our members, don't trade headlines. If you trade headlines, I guarantee you the headlines were great right here. Euphoria is created, and then Wall Street comes in and takes the legs out from under it and pulls the rug on it. because they want to take out all the weak traders. They want to take out all of the weak holders before they go into the next leg, which is the continuation of their markup campaign. And if we jump over to last week's chart, this is now May 16th. We see that's what's happening. We see the continuation. We see the breakout to all-time highs. This is what phase E of an accumulation cycle looks like. The tape gets quiet. The base right here finishes up and markup resumes. We're seeing a clean break here of the bundled weekly moving averages. This gold one, that 30-week simple moving averages right here, the red one, the 55-week exponential moving average is also in there. All of the moving averages are starting to fan out and turn upward. We have an upward sloping 200 weekly exponential moving average. These are all signs. These are all signals that markup is continuing. Our next target is this 1618 at the 132, 131.90. That will be our next target. If we jump over, if we zoom in into the daily structural evidence gets even clearer. This is exiting now. It's long-term accumulation structure from 2024 and 2025. Each one of these sell-offs, you can see volume begins to decline on the sell-off until it gets to the bottom. At the bottom, we see volume picking up. This is classic reaccumulation activity. We know institutions want to reacquire their positions, but they want to force you out first. They want to bring price down so they can accumulate and scale, but they want you to get out. So that's why we have negative headlines. We have a lot of fear, uncertainty, and doubt associated with these time periods. Whether it's reaccumulation or whether it's accumulation at the bottom, expect to hear bad news because Wall Street is trying to build their position. And when they're building, they want to scare retail traders out. Once they complete their rebuilding process, once they've reaccumulated their position, it's time for them to defend this base, and to defend it, they have to leave it. That's why we have this breakout here. That's why we see the moving averages beginning to curl up. This is classic early markup activity. The volume profile confirms everything we just discussed. We can see the thick profile here at the bottom. This is where Wall Street is accumulating their position. This is where in trade therapy content and clarity for our weekly readers, we talk about buying when they buy. We talk about selling when they sell. If you were accumulating down in here, you'd be getting paid right now. We also talked about how there's no supply up here. This is blue skies. See how there's nothing up here? We're now into price exploration. So what does that mean? That means that institutions are going to try to create distance away from this base that they just created here. They want to defend their position, and to do that, they have to extend price away from it. This is a classic Can Slim Bill O'Neill entry point right here, breaking out of the long-term range and taking advantage of the markup campaign in its early stages here. This is why in trade therapy content, we are constantly preaching to our members, don't rely on the headlines to tell you when to buy and sell. Don't rely on CNBC to give you financial advice because they're not going to. Learn to read the charts. The charts always tell the story if you know how to read them. If you're watching these videos, but you're not subscribed to Clarity content, you're doing yourself a disservice. Read Clarity, trade the structure, follow volume, and align with institutional behavior, not media behavior. It'll give you an edge in the market.